Have you ever wondered how the financial markets stay stable even when huge amounts of money are moving around? Every single day, today we are going to explore the world of position limits, which are the essential regulatory guidelines that set the maximum allowable exposure for everyone involved in trading, from large banks to individual investors, in order to prevent any single person or company from building up dangerously large trades. The regulator has put specific boundaries in place. These position limits represent the highest level of risk allowed for the entire market, as well as for each trading member and individual investor, and they are checked at three different levels: the client level, the member level, and the currency level. Moving on to the specific rules for trading members, such as banks and other large institutions, the limits are quite clear. For most currency pairs, the limit is the higher of 15% of the total open interest, or a specific floor such as 100 million USD for the USD-INR pair, or 50 million EUR for EUR-INR. However, for certain bank trading members authorized by the RBI, the total open position across all contracts is allowed to be much higher, reaching up to 15% of the total open interest, or 1 billion USD, whichever is greater. Now that we understand the limits for big institutions, let's look at domestic clients, non-resident Indians, which we call NRI, and certain foreign investors. For these participants, the limits are set lower to ensure safety, usually at the higher of 6% of the total open interest, or specific floors like 20 million USD for the USD-INR pair and 10 million EUR for the EUR-INR and EUR-USD pairs. Building on that, we also have rules for the proprietary positions of stockbrokers who are not banks. These brokers must follow a limit that is generally the higher of 15% of the total open interest, or specific amounts such as 50 million USD for USD-INR and 25 million GBP for GBP-INR. Stockbrokers must also ensure their total combined proprietary positions across all foreign currency and INR pairs stay within consolidated limits. For a bank stockbroker, this consolidated limit is the higher of 15% of the total OI, or 200 million USD, while for a non-bank stockbroker, that floor is set at 100 million USD. Now, let's look at a very important rule regarding a single limit across all currencies involving the Indian rupee. According to a circular from April 7, 2020, users are permitted to take positions up to a single limit of 100 million USD equivalent across all currency pairs involving the INR when combined across all exchanges. If a user needs to go beyond that 100 million USD limit, there is a specific procedure to follow. They must first designate an authorized dealer or a custodian, and while the exchanges will report the trading data, the responsibility for staying compliant rests entirely with the user, as breaking these rules could lead to action under FEMA 1999. Beyond the basic numbers, there are other important guidelines to remember, such as the fact that limits are based on the previous day's open interest and are checked exactly when you open a new position. If the total market interest drops later, it is called a passive breach, and you do not have to close your trade immediately, but you cannot add any more to your position until you are back within the limits. It is also worth noting that while clearing members do not have their own separate limits, they are held accountable for making sure all the trading members under them stay within their boundaries. When we calculate these positions, we group long futures, long calls, and short puts together as long positions, while short futures, short calls, and long puts are treated as short positions. All of these rules are backed by a strong legal framework including the Foreign Exchange Management Act of 1999 and the FEM regulations of 2000. These laws, along with master directions from the RBI and guidelines from SEBI, work together to manage risk and maintain a healthy environment for interbank dealings. To make sure everyone follows the rules, there is a continuous monitoring cycle where the clearing corporation provides position limits in lots for the next day. This creates a chain of accountability that flows from the clearing member to the trading member and finally down to the individual client. To see how this works in real life, by comparing two different exchanges, imagine exchange A has a total open interest of 4 million contracts, while exchange B has only 0.5 million contracts, with each contract worth 1000 USD. In this scenario, for a trading member at exchange A, the 15% limit would be 0.6 million lots, which is much higher than the floor. But at exchange B, 15% of the total interest is only 0.075 million lots. So the higher floor of 0.10 million lots or 100 million USD would become their official limit for the next day. Finally, what happens if someone breaks these rules? If a limit is exceeded at any time, it triggers a violation which can lead to the member being restrained from taking new positions, being forced to reduce their trades, or even facing a financial penalty. It is all part of a system designed to keep our financial markets safe and disciplined for everyone.